Hey everyone, ready for a deep dive into value investing?
I am ready. Let's do it.
Perfect. We've got some interesting sources today.
Oh, yeah. Lay it on me.
Excerpts from a book called The 8-Step Beginner's Guide to Value Investing.
Okay.
And to make things even easier, we've got a so brief summary of the same book.
Sounds like we're well equipped for this dive.
Definitely. And get this, the book has a whole section on 20 stocks they think will do amazingly well over the next 20 years.
Ooh, that's got to be interesting. Always love a good prediction.
Me too.
Uh,
But before we jump into those, you should probably lay some groundwork.
Yeah, for sure.
What exactly is value investing?
Exactly. So this book, it really busts this myth of getting rich quick.
Right.
It's all about playing the long game.
Okay.
Steady growth
Makes sense.
over years or even decades.
So it's kind of like planting a tree, right?
Yeah.
You nurture it, you give it time, and eventually, boom, you've got fruit, you've got shade, the whole package.
I like that analogy. It's about building something sustainable.
Exactly. And speaking of long-term, you mentioned that list of 20 stocks.
Oh, yeah. That's going to be fun to explore.
Definitely saving that for later, though.
For sure.
First, let's talk about a huge GG concept in value investing. Intrinsic value.
Yes.
Yeah.
Intrinsic value. That's the heart of it all.
So, in a nutshell, what is that?
Okay, so imagine you're buying a used car, right?
Okay.
The sticker price, that could be way off.
Could be inflated, hiding problems, who knows?
Right. But the intrinsic value, that's about the car's real condition.
So like how well it runs, how long it'll last, all that.
Exactly. It's the true worth beneath the surface.
I get it. So we're not just looking at a company's stock price. We're trying to figure out what it's really worth based on its potential.
Exactly. It's like peering beneath the hood, looking at the engine, not just the shiny paint job.
Love that. So how do we even start to uncover that intrinsic value?
Well, one key principle is buying below that intrinsic value.
Okay.
That's where the margin of safety comes in.
Margin of safety, gotta love a safety net. What's that all about?
It's like having a buffer, right? Just in case our calculations are a bit off.
Or if the market takes a sudden nosedive.
Exactly. It's that cushion to protect you.
So kind of like getting a discount on that used car.
Exactly. You've got some wiggle room if things don't go exactly as planned.
Now that makes me feel better already.
It's all about managing risk. And speaking of things that make you feel better,
Hit me with it.
economic moats.
Economic moats. Sounds pretty defensive.
They are. Think of them like competitive advantages,
Okay.
things that protect a company from its rivals.
So like what? Give me some examples.
Well, the book uses some great ones. Coca-Cola with its brand recognition, Amazon with its massive scale.
Right. You don't just build that overnight.
Exactly. And the So Brief also mentions Disney and its, massive library of intellectual property.
Mickey Mouse and all his friends. Those are some seriously valuable assets.
They are. And these economic moats, they give companies some serious staying power.
They've built these empires by consistently delivering value and fighting off competition year after year.
Right. And to really understand if a company has this staying power, we've got to dive into their financials.
Okay, now you're talking my language. Numbers.
Don't worry, though. You don't have to be a Wall Street whiz to get this stuff.
I'm all ears.
The book breaks down some key metrics even beginners can grasp.
That's good to hear, because I've definitely felt intimidated by financial statements in the past.
It's totally understandable.
Yeah.
But once you get the hang of it, it's actually pretty fascinating.
So walk me through it. What are these key metrics we should be looking at?
Well, one you've probably heard of is the PE ratio.
Oh yeah, the PE ratio. I hear that one tossed around all the time.
So think of it like this. You're buying a slice of pizza.
Pizza. Now you're speaking my language.
The PE ratio tells you how much you're paying for each dollar of that pizza's, profit.
Interesting. So if a company has a high PE ratio,
It could mean the market is expecting big growth from that company, like a really delicious in-demand pizza slice.
and a low PE ratio.
Could signal that the market's underestimating that slice. It might be a hidden gem.
Okay, I'm starting to get it. So we're using these metrics to peek behind the curtain and see if the company's numbers are as strong as their brand or their market position.
Exactly. We're looking for that alignment between what we see on the surface and what's going on underneath.
Makes sense. What else should we be looking at?
Well, there's the debt-to-equity ratio.
Debt to equity ratio. Okay.
This one gives you a sense of how much debt the company is carrying compared to its ownership equity.
So like, are they borrowing a ton of money to operate?
Exactly. And too much debt, that can be risky, especially if the economy takes a downturn.
It's like checking the car's loan history before you buy it, right?
Right.
You want to make sure it's not burdened with tons of debt.
Perfect analogy. You don't want to buy into a company that's drowning in debt.
Now, what about free cash flow?
Ah, yes, free cash flow. That's the cash a company has left over after paying for its operations and investments.
So it's not just about revenue, it's about how much cash they're actually generating.
Exactly. A company with strong free cash flow, they've got more flexibility to invest in growth, pay dividends, or even buy back their own shares.
Got it. So it's a good sign if they've got plenty of cash to play with.
It's a sign of financial health, like having a good emergency fund.
This is making me feel like a financial detective.
That's the spirit. Now, even with all this analysis, remember, the market can be a bit of a wild ride.
Oh yeah, definitely unpredictable.
And the So Brief brings up a really important point about diversification.
Diversification that's spreading your investments around.
Exactly. They highlight the study showing that owning 20 stocks can significantly reduce your risk compared to just holding one or two.
It's like that old saying, don't put all your eggs in one basket.
Ah,
But how many stocks is enough?
yeah.
I've heard so many different opinions.
Well, the book suggests aiming for somewhere between 10 and 30, but it really depends on your personal risk tolerance and what you're trying to achieve with your investments.
Makes sense. So diversification, it's not about randomly buying a bunch of stocks.
No, it's about building a balanced mix across different industries and sectors.
To cushion your portfolio if one area takes a hit.
Exactly. It's like creating a safety net for your investments.
Yeah. Even with a diversified portfolio, market downturns can still be scary.
Oh, absolutely. But here's the thing. Value investors, they see volatility as an opportunity.
Okay, how so?
Think of it like a Black Friday sale for stocks.
Oh, I like that.
Prices drop, sometimes dramatically, but the value of the underlying companies might still be solid.
So it's a chance to buy low when everyone else is panicking.
Precisely. And that's where having a strategy comes in handy.
Like what?
The book suggests keeping some cash reserves,
Okay.
so you're ready to buy when those dips happen.
Smart. Always be prepared.
And then there's dollar cost averaging.
Dollar cost averaging. Remind me what that is again.
So instead of trying to time the market perfectly,
Right. Which is basically impossible.
exactly, you consistently invest a set amount of money at regular intervals,
Okay.
no matter what the price is doing.
So you might buy more shares when the price is low
Yes.
and fewer shares when the price is high.
It helps you average out your purchase price over time.
Got it. This is starting to make a lot of sense. But value investing does sound like a long game.
It is a long game, but that's where the magic of compounding comes in.
Compounding, that's where things get really exciting.
It is. Imagine a snowball rolling down a hill, getting bigger and bigger as it picks up more snow.
Oh, I love that analogy.
Yeah.
So our returns generate more returns, and those returns generate even more returns.
Exactly. It creates this incredible snowball effect over the long term.
And the longer you let that snowball roll.
The more massive it becomes.
Exactly. Now, you mentioned earlier a way to turbocharge this compounding effect.
I did. Dividend reinvestment plans, or DRIPs.
DRIPs, they sound pretty sweet. How do those work?
So when you own stocks that pay dividends, those dividends get automatically reinvested back into buying more shares of that company.
Ah, so it's like earning interest on your interest.
Precisely.
Yeah.
The snowball keeps growing faster and faster.
I love it. Now, before we get too carried away with the compounding magic,
Right.
you mentioned that 20 for 20 list the book's predictions for stocks that will do well over the next 2 decades.
Oh, yeah. We can't forget about that.
Now that we've got the basics down, I'm dying to know what they picked and why.
Okay, let's dive into that list.
Let's do it.
All right, time to unpack this 20 for 20 list.
Yeah, I'm ready. It's not just some random stock picks, though, right?
Right. This isn't about giving you a stock shopping list.
So it's more about teaching us how to think like a value investor.
Exactly.
Gotcha. So what can we learn from these picks?
Well, it's based on all those core principles we've been talking about.
Okay, so like intrinsic value, economic moats, strong financials, all that good stuff.
Exactly. They've used all those criteria to handpick these companies.
And the excerpts we have don't actually list all 20.
Right, but we get some clues from the So Brief.
Okay, like what?
They mention Coca-Cola, Amazon, Disney companies with those strong economic moats.
Ah, yeah, we talked about them earlier. Those companies have serious staying power.
Exactly. And the So Brief makes a great point. You got to understand a company's business model before investing.
Yeah, for sure.
They even have this quote, "If you can't explain what Walmart does in 30 words or less, you probably don't understand it well enough to invest in it."
Love that. Don't invest in what you don't understand.
Right. So these companies on the list, they probably have pretty straightforward business models.
Okay, that makes sense.
If they're going to be thriving in 20 years, it can't just be some fleeting trend.
Yeah, totally. They need to have a clear path to long-term success,
Exactly. We're looking for those companies that can adapt and evolve.
not just capitalize on a fad or something.
Right. Now, what about diversification? Does the list cover a bunch of different industries?
Yeah, that's a good question. I'd hate to see them all in one sector.
Well, remember the Brief mentioned aiming for a portfolio of 10 to 30 stocks across different sectors.
Yeah.
So it's safe to assume they've got a good mix in their picks.
That makes me feel better. Spreading that risk is key.
Definitely. But even if these companies are supposed to grow like crazy, we still need to think about valuation, right?
Oh, yeah. Doesn't matter how great a company is if we pay too much.
Exactly. And the Brief reminds us valuation matters.
So how do we make sure we're not overpaying?
Well, they suggest using some of those metrics we talked about, like the PE ratio.
Yes, the price to earnings ratio.
Right. And then there's the PD ratio, price to book ratio.
Okay, PV ratio. Haven't heard of that one.
So that one compares the company's market price to its book value, which is basically the value of its assets minus its liabilities.
So kind of like comparing the sticker price of that used car to the actual worth of its parts.
Exactly. If the price is way lower than the parts are worth, it could be a steal.
Okay, I'm getting it. Any other valuation tools?
They also mention using DCF analysis, discounted cash flow analysis.
Oh, yeah, we talked about that one earlier.
It helps estimate the company's intrinsic value.
Right, by looking at all its future cash flow.
Exactly. So even though these companies have amazing potential, it doesn't mean we buy them at any price.
We got to make sure we're getting a good deal.
Always. Remember, the market can be irrational, especially in the short term.
Oh, yeah, definitely.
Even amazing companies can see their prices fluctuate for reasons that have nothing to do with their actual performance.
Like those flash crashes you mentioned.
Exactly. We can't get swept up in the moment.
Right, got to keep that long-term focus. What else can we learn from this list?
The Brief highlights something they call a rational process for analyzing stocks.
Okay, so not just following gut feelings.
Nope. It's about having a systematic approach, using data and evidence to make smart decisions.
Love it. Becoming financial detectives.
Exactly. And lastly, they leave us with a super important reminder. Continuously educate yourself and stay informed.
So true. The learning never stops.
Never.
Okay, I'm feeling really pumped about this whole value investing thing. But, it can be pretty emotional, right?
Oh yeah, for sure. Fear and greed can get the best of us.
So how do we manage those emotions and not make rash decisions?
That's where behavioral discipline comes in. The book really stresses recognizing our emotional biases.
Okay, so like understanding how our emotions can trip us up.
Exactly. Fear and greed, they can cloud our judgment.
So even if we have the perfect strategy, our emotions can still mess things up.
They can. Think about it. When the market's booming, it's easy to get caught up in the excitement.
Yeah, you start thinking you can't lose.
Right. But then when things take a dip.
Panic sets in.
Exactly.
Yeah.
So we need strategies to stay grounded.
Okay, I'm all ears. How do we keep a level head when the market's going crazy? All right, spill the beans. How do we keep those emotions in check?
Well, the book emphasizes having a clear investment plan.
Okay, solid plan makes sense.
And stick to it no matter what.
Easier said than done sometimes.
Oh, absolutely. But that's where discipline comes in.
So what should this plan include?
Well, first, you got to define your goals.
Goals, right?
What are you trying to achieve with your investments?
Retirement.
Yeah.
A down payment on a house. Early retirement, maybe.
Yeah, exactly. Could be anything.
Yeah.
But you got to have that clear vision in mind.
Okay, so know your goals. Got it.
Then figure out your risk tolerance.
Risk tolerance. So like how much up and down can I handle before I freak out?
Exactly. Can you sleep at night if your portfolio drops 10%, 20%?
Ooh, those are some big numbers. Makes you think.
It does. And finally, you got to set a realistic timeline.
Timeline. Okay.
Are you investing for the long haul, like 30 years? Or do you need that money sooner?
Right, because that'll definitely affect the types of investments you choose.
Absolutely. So having that plan, it's like your roadmap.
Okay.
It helps you stay on track when those emotions start to get the better of you.
So when fear and greed come knocking,
You go back to your plan, you look at the facts, and you make rational decisions.
no more knee-jerk reactions.
Exactly. Remind yourself of those fundamentals we've been talking about.
Okay.
Those financial metrics, those economic moats. Ask yourself, has anything really changed about this company?
Is it still a good long-term investment?
Exactly. Sometimes the best thing to do is just tune out the noise and trust your plan.
Sometimes ignorance is bliss.
Right.
Oh, not really ignorance, but you know what I mean.
Yeah, I getcha. And hey, if things get too overwhelming,
Take a break.
exactly, step back, reconnect with your goals, come back with a fresh perspective.
Love it. All right, so before we wrap up this deep dive, let's recap those steps for our listeners.
Okay, sounds good.
So, first things first, think long term.
Yes. Don't try to time the market. Focus on those companies with lasting value.
Ones that'll still be around in 20 years, crushing it.
Exactly. Remember that tree analogy.
Plant it, nurture it, and eventually you'll be enjoying that shade and those delicious fruits.
Perfect. Step 2, learn the basics of financial analysis.
Yeah, get comfy with those metrics.
PE ratio, debt to equity ratio, free cash flow. It's all part of becoming a financial detective.
It's like learning a new language.
It is, but once you know it, you can unlock so much information.
Exactly. All right, step 3, build your own process for evaluating companies.
Yes. Create that checklist. Figure out what matters most to you.
So like strong management team, consistent profits, ethical practices, whatever's important.
Precisely. Make it your own.
Okay, step 4, diversify.
Don't put all your eggs in one basket. Spread that risk around.
Right, find that balance that works for you.
And step 5 may be the most important one.
Hit me with it.
Master your emotions.
Oh boy. Yeah, that's a tough one.
It is, but it's crucial.
So have that plan, stick to it. Don't let fear and greed make decisions for you.
Exactly. And finally, never stop learning.
Preach.
This world of investing, it's constantly changing, so stay curious.
Read those books, attend those webinars, talk to other investors.
Exactly. Knowledge is your best weapon.
Wow, I feel like we've covered so much ground today.
We have. Value investing, it's a journey, not a destination.
So true. And I hope our listeners feel ready to start their own journey.
Me too. Remember, it's a marathon, not a sprint.
Take it one step at a time, stay focused, and never stop learning.
Couldn't have said it better myself. Thanks for joining me on this deep dive.
It's been a pleasure.
Yep.
And to all our listeners out there, happy investing.